So good morning to everyone. Last time we were talking about investment banks and security brokers. So essentially investment banks, we were on the topic of investment banks. And talking about investment banks, we were talking about what they were engaged in, and we were in the middle of IPOs, right? So when we talk about investment banks, the main thing to understand is they are not commercial banks. They don't take deposits. They are essentially arrangers of transactions who provide investment advisory services. So they are the people who will connect corporates with essentially buy-side investors. So investment banks are sell-side entities who connects corporates, generally not HNIs, right? Because it's people who want to raise funds, but it's corporate. It's not in terms of large investors generally on special occasions, depending on what type of transactions it could be. But here you're not talking about helping somebody get a loan. Here you're talking about helping a company raise funds in the capital markets, right? And other advisory services. So they will help corporates connect with the buy-side investors, which includes HNIs, which includes fund managers, pension fund managers, and so on. So commercial banks, we said they take deposits and they will take those deposits and then on lend. Investment banks do not. In general, most investment banks in Sri Lanka, especially, investment banks will work for a fee. They will work on a fee-based mandate, right? Meaning they will charge a fee for the advice that they provide. Versus in the US, you also have fund-based mandates where they will work for essentially, they will invest money from their funds as well, or they will trade on their proprietary book. So some of the large investment banks that you will hear of are Goldman Sachs, Morgan Stanley, JP Morgan, Barclays, right? These are some of the large investment banking names that you will hear. And the main activities of investment banking are underwriting. And in terms of underwriting, what do we mean? Helping corporates raise funds, fundraising activities, as well as advisory, especially M&A advisory, mergers and acquisition advisory services. So in Sri Lanka, we don't have the term investment banking. The new term that is defined for investment bankers by the SEC, according to the SEC Act, is the corporate finance advisor. So investment banks are required, if they want to offer these advisory services, in terms of fundraising activities, listing activities, and so on, they're required now to get a corporate finance advisor license from the SEC. So we were going through the list of things that investment banks do in terms of what is their work scope, right? And we spoke about how they provide services in terms of raising commercial paper, raising securitized paper, syndicated loans, project financing, right? They also do market research. If, for example, a company wants to set up a new office, let's say in Sri Lanka, that feasibility, marketing feasibility research can be done by investment banks, right? If a company wants to set up a new unit and they want to do a feasibility analysis or they want to find out more about the industry, that type of research can be mandated to an investment bank. If a company wants to spin off a division or they want to sell off a certain subsidiary of theirs and they have an investor, but they want to figure out what is the valuation to do it, that type of business valuation can be done by investment banks. Balance sheet restructuring advisory services can be done by investment banks, where you look through your balance sheet to see how you can optimize it. What is a good debt to capital ratio to have? What is the type of loans that you should be having in terms of floating, fixed? How do we convert these loans from fixed to floating or floating to fixed, short term to long term or long term to short term, right? So in terms of looking through the balance sheet and figuring out what is the debt to equity ratio to have, what is the fixed to floating ratio to have, what is the long-term to short-term type of loans to have, given the current interest rate environments and the expected interest rate environments. These types of advisory services investment banks can do for you. So balance sheet and business restructuring advisory services. So they essentially provide advisory services for a fee. And we were in the middle of in the middle of how investment banks help in fundraising activities. And the main fundraising activity that they do is IPOs, initial public offerings, where they help companies or facilitate companies raise money through the equity or debt markets, right? So we talked about, in terms of IPOs, we were talking about how in the IPO process, once you select an investment bank, then the investment bank helps the company do the rest of the work scope that is there in IPOs, including due diligence services, right? Due diligence advisory in terms of figuring out everything that they need to know about the company, right? Figuring out what are the key drivers of the company, what are the financial accounts of the company, what are the land bank they have, other assets that they have, any legal, any litigation that the company is engaged in, right? So you have to know everything about the company because you're trying to do a valuation of the company, you, the investment bank. And you are also trying to sell the company to investors. So when investors ask questions, you should have a very thorough understanding about the company. Yeah. And then investment banks will help in the pricing of the issue, right? Pricing of the issue. So, yeah. Before we come to the pricing of the issue, if you all remember the three terminologies of how you list: offer for subscription, offer for sale, and introduction. Where offer for subscription is where you issue new shares, where the company issues new shares and offers it to the public to come and subscribe for their shares, and the company raises money. Offer for sale is existing shares being sold to the public, and the selling shareholder makes money. And introduction is simply a way that you introduce the company to the stock market by simply listing the company. You have a prospectus, or you call it introductory document, that details the description about the company, but essentially you are just simply allowing your shares to be traded. You are not raising money, neither for the company nor any shareholders of the company. Once you list it, existing shareholders can decide when they want to exit to offer those shares in the exchange. And if there's interest, somebody will buy it and you can exit. We spoke about best efforts underwriting and firm commitment underwriting. Best efforts underwriting is what usually happens in Sri Lanka. Sri Lanka also has firm commitment underwriting, but very rarely. This is the opposite of kind of how it works in the US. US mostly has firm commitment underwriting and a lower ratio of best efforts underwriting. Best efforts underwriting is essentially where you undertake the IPO, you undertake to sell the shares of the company or the debentures of the company and help the company list and raise funds, but on a best efforts basis. So the investment bank doesn't guarantee that they will be able to carry out that transaction completely and be able to raise all the funds that the company requires, but they will make their best effort, meaning that they will do everything in their power necessary. They will do the marketing, they will talk to the large investors, they will get them excited, they will talk about the story, they will do everything in their power to help the company raise the funds that is required, but it is not guaranteed. So there is a risk of your shares being undersubscribed or your debentures being undersubscribed in the IPO. Versus in a firm commitment underwriting, the investment bank essentially guarantees, right? So in Sri Lanka, you know that there is a difference between an underwriter and an investment bank. You have to get two separate licenses, one for corporate financial advisor, which is essentially the investment bank, and one for underwriter. Investment bank, they can look at getting a license as underwriter, but right now we have two sets of entities who do the underwriting and who do the corporate finance advisor service. So in a firm commitment underwriting, you have an underwriter, right? In the US, this will generally be the investment bank itself. In Sri Lanka, it will be a third party who is licensed to underwrite. And here, what will happen is you are always guaranteed that the IPO will be fully subscribed. The company will always be guaranteed that the IPO will be fully subscribed, because in a firm commitment underwriting, the investment bank in the US will buy all the shares and simultaneously sell it to the public. So that the company is guaranteed that they are completely fully subscribed in the share issue. Versus in Sri Lanka, in a firm commitment underwriting, the company, as usual, will sell the shares to the public, and if there is any shortfall, the underwriter will guarantee that shortfall, and they will subscribe for that shortfall in shares. Okay, so we were in pricing, and we were talking about how in pricing there are two ways that you can essentially look at pricing an IPO. Right? And usually in Sri Lanka, we have what we call fixed price IPOs, right? Was not Dutch auction type IPOs. So we do book building exercises in Sri Lanka in a more informal manner. Book building essentially is a way to try to figure out what is a good price to offer to the public, right? What is a price that will get the public excited to invest in this company? So you might select a few large investors, go to a few large investors and do a brief presentation. The investment bank might do a brief presentation or give a few features of the company and try to figure out, okay, what is the price range that the investors will be interested in. They will offer a price range and then they will hash out in terms of whether this price range is fair and reasonable, right? So that's something that might happen in the way we work in Sri Lanka. So it's not exactly book building. Book building as a process is where you essentially allow the investors to bid for the price and to bid and say, this is the price that I want to invest. This is how much I think this company is worth, right? So they will make the bids. So in a proper book building process, what will you do? You will take the company, you will showcase the company so that the investors understand what is this company doing, what are the underlying features, what are the key drivers. You will showcase the company, and then you will make allow the investors to make their decisions, and you will do a book building process where you try to figure out in terms of what is the correct price to offer this to the market. Okay, so this again, the book building process will be done by a smaller subset of investors, usually your larger investors who can take a larger volume of your IPO, because by the time you have that set of investors, most of your IPO is filled, right? If you have the interest of those investors, the larger investors that you're offering to, then most of your IPO, most of the work of the investment bank is done. Because your IPO, if you have a 5 billion or a 2 billion or a 1 billion requirement to raise money, the large investors can take a bulk of that requirement. So you only need to go to the retail investors or the smaller mid-tier investors with the remainder. So that's what the book building exercise helps you do. It helps you fill up in terms of interest for the issue. It helps you fill up the interest for the issue. So in Sri Lanka, we had a kind of, so we do an informal type of book building exercise. And we don't have the Dutch auction process, except in a few IPOs from between 2004 to 2007 or so. We had a few IPOs that came out with the Dutch auction process, modified Dutch auction process, right? So the first IPO to do that was Lanka IOC, and then Dialogue did it, and a few other IPOs did it. And afterwards, it died down because the interest for IPOs also died down. And it became a little bit more difficult to raise money in the market through IPOs. We'll talk about that a little later. So what happened in that process? So like I was explaining last time, you offer investors a series of prices, right? In a proper Dutch auction process, what would happen? You would allow the investors to bid. Investors will take the decision and they will bid. This is exactly like a treasury bill or treasury bond auction. investors will take the decision on what price to bid, and they will make a bid. They will look through the merits of the company. They will look through the features, the key drivers, everything. They will do their own valuations as well. And the larger investors will make some bids in terms of what they think this company is worth and how much they're willing to buy. Okay. So in a proper Dutch auction process, just like a treasury bill or treasury bond auction, you will have investors coming in at different prices and offering to buy shares of this company at different prices, right? So you will have certain number of shares being bid for at certain prices. So the company, to their advantage, obviously, will accept the highest offer first, because the company is looking to raise money. Company is looking to raise money, so they will accept the highest offer first. And from that point onwards, they will keep on accepting offers until they reach their target price, target fundraising requirement. Okay, so if they want to raise, I'm still keeping my example of 5 billion rupees, right? If they want to raise 5 billion rupees, they will keep accepting these offers of shares that have been made until they raise 5 billion rupees. Anybody who has been below this threshold, where the company raises 5 billion rupees, anybody who has bid below this threshold does not get any shares allotted to them. Versus anybody who is within this threshold, everybody gets allocated at the lowest price that has been bid. Remember, just like a US Treasury bill auction that we spoke about, everybody gets allocated at the same price. It's a single price, and you get refunded for the remainder of whatever you have bid, right? So that's how a proper Dutch auction process would work. And in Sri Lanka, for the IPOs that happened, we did a modified Dutch auction process where investors were given a range of prices in these IPOs, and investors could choose to bid for any of these, between any of these range of prices. So some investors would choose to bid at this price, some at this price, right? So they would say how many shares they want to bid at each of these prices. And then the company would start collecting from the highest share price, just like before, because the company is trying to raise funds. So it is advantageous for them to start collecting the money, start accepting the money from the highest price that is being offered to them, right? So they will start accepting the money at the highest price. And if the IPO gets oversubscribed at the highest price, everybody below that highest price gets rejected. Everybody who bid below the highest price gets rejected. If the IPO does not get subscribed at the highest price, then what happens? You keep on building up until the point where the IPO gets fully subscribed. Okay. Once the IPO is fully subscribed, everybody who bid 10 and above gets allocated. Everybody who bid below 10 gets rejected. And everybody, whether you bid at 11 or 12, everybody gets allocated shares at 10 rupees each. So in IPO in Sri Lanka, we will send checks, right? We'll send checks, or we will do an RTGS transaction or transfer at the price that we're bidding at into the number of shares. And then only we'll tally it out. So once we tally it out and we figure out, okay, this is my cutoff price and this is the price that I'm going to accept the IPO at, then everybody else gets a refund. So people who bid at 11 will get a 1 rupee refund. People who bid at 12 will get a 2 rupee refund per each share that they bid. So this was the kind of modified Dutch auction process that we carried out in Sri Lanka. So you can do either way. You can do fixed price IPOs, or you can do a book building exercise for modified or like a Dutch auction process in terms of trying to figure out the price. So the advantages and disadvantages in a Dutch auction process is for hot IPOs, for IPOs that have a lot of demand and a lot of interest from investors, company can actually maximize the price that they raise the funds at. They can raise more funds if required. They can maximize the price that they raise the funds at. Versus in a fixed price IPO, that's it, right? You either raise the money or you don't raise the money, you feel it or not. Investors have no choice. Similarly, in a Dutch auction type IPO, you run the risk, the company runs the risk that they might not get everything they need at the lower price levels. There might be a price that is, for example, a fair price for the IPO. There might be a price that is, because usually when I say fair price for the IPO, what that means is the company can be worth 12 rupees. But most IPOs are offered at a discount to what it is worth. Okay. Most IPOs are offered at a discount. Most, sometimes not all, but most, right? Now, for example, last time I used the example and I said a company, you can do the valuation. A lot of the time, what the investment bank will do is after understanding this company, talking to the management, looking at their future plans, they will forecast the cash flows, the free cash flows, right? So when we do equity valuation, we'll talk a little bit about free cash flows. They will forecast the free cash flows that you expect from this company, and you will discount it to today's price. And you will try to figure out, okay, how much is this company worth, right? What is the value of equity of this company? So once you know the value of this company is a 50 billion rupee company, right? 50 billion rupee company. Then you divide that by the number of shares and you figure out, okay, what is the share price that we should offer? And I told you, when you come to the market, generally, it's just market psychology. Usually you will offer share prices that have low values, just as a market psychology in terms of attracting investors to come and invest in the share. It has nothing to do with the total value of the company. But the individual share price might be a low value share. So, for example, the last time the example that I gave was, if this company had 1 billion shares, the share price per share of this company is worth 50 rupees, right? But if you try to come with an IPO to the market and offer the IPO at 50 rupees a share, it might be a little too, investors might feel that it's a little too expensive. To pay 50 rupees per share might not be something that the investors want to do, to buy one share, to pay 50 rupees a share, because that means by the time they buy 100 shares, they've spent 5,000 rupees and so on and so forth, right? So in this case, the company might do just a share split. So the company is still worth 50 billion, but all they've done is they changed the number of shares from 1 billion. They do a 1:10 split to make these shares, the number of shares 10 billion. Right now, I'm putting fantastical numbers here, and offer it to the public at 5 rupees a share, which is, to the public, it looks a little bit more affordable, right? It has nothing to do with affordability. It's simply psychology. You're still buying the same number of, percentage wise, you might still be buying the same number, same company. But the other thing that companies do in an IPO is that they offer a discount to this fair value of the company, right? So usually IPOs might come, although it's worth 50 rupees, it might be offered to the market at, I'm just putting numbers again, 40 rupees. So they come out, and the investment banks, when they go doing their road shows and they go to investors and they talk and say, invest in this IPO, they will say, okay, this IPO, this company is worth 50 rupees, but we're offering it to you at 40. There is a discount. And why is this discount? Why is that discount there? This is because the company is not a listed company. There is no transparency in the company. And you're asking investors to come and take a risk and invest in a company that has no trading history. And therefore, once the company starts trading, you don't know whether it will do well or not. So investors technically are taking a risk. So to compensate for that risk, you generally offer a small discount to the fair market value of the company. Okay. So most of the time, that's why investors like IPOs, right? Because there is additional money on the table to be made. If you say this company is worth and it should give you a 20% return, actually, on an IPO, you can get higher returns than that because the company is offered to you cheap most of the time. Okay. So if, for example, you have a book building method, then what happens is, although the company in a fixed price IPO, you might be offering it at 40, and at 40, even it can be undersubscribed if the investors feel that this valuation is wrong. It shouldn't be, it's not worth 50. The investment bank or the company hasn't done their job. It can get undersubscribed, or simply market dynamics means that it can get undersubscribed. But on hot IPOs, right? Hot IPOs meaning where there's a lot of demand, you might see that the bidding process will help the company achieve its full potential. Investors might finally subscribe for the IPO at how much it is worth, or 5 rupees, whatever, at how much it is worth. Okay. Without subscribing for it at a discount, they might subscribe for it at fair value because there is so much demand for the IPO. They might be okay to subscribe for it without the discount. So you offer investors the price with and without discounts. Okay. And some investors will bid at 350, some investors will bid at 450, 5. And for very high demand IPOs, ultimately you might be able to raise the money at the fair price for the company. So the company gets everything it wants, all the funds that it wants at the fair price. It doesn't have to offer anything additional to the investors. So depending on how, how much demand there is for this IPO. So IPOs usually are underpriced, priced at a discount, right? So you can see here some, because we don't have any research that has been done in terms of the underpricing of IPOs, or we don't have in the public domain a lot of research available of underpricing of IPOs. So there's a lot in the public domain on underpricing of IPOs. You can see here some of the stock price gains of internet companies on the first day of trading. Part of the reason why do IPO prices suddenly jump on the first day of trading? Part of the reason is because IPOs are underpriced to begin with. So you're already buying a share that has higher value than what it is worth, because the company has been offered to you at a discount. So other than some very, at that point, hot shares, right? Like eBay, who at that point when they did the IPO and they came to the market, you will still see a lot of the time IPOs offer good first day gains. This is the average IPO first day returns from 2000 to 2016. This is a study that has been done. The first day, the return on the first day of an IPO, on average, for all companies that have carried out IPOs on that year, 52% returns, 13% returns, 12% returns, right? 52 is very high. It should have been because 2000s anyway was the tech stock boom. So you had that unusual gains coming in there with the tech stocks. But you can see here, 13, 12, 12, 9, 10. So that 10 to 12 range is the type of discount that is there. That is the additional return that you can get from buying a share in an IPO because of that additional discount that has been given. So you can see here in the Google IPO again, the book building process, kind of where they have indicated the expected price range, 108 to 135, and within that range, then they will do a book building to see where the final price will settle at. So once you do this whole thing, you now send an application to the stock exchange, what we call the initial listing application of shares, right? Who will do this? The investment bank will facilitate this process again. They will work with the company to make sure that all the documentation is in place, like certificate of incorporation, your articles of association, board resolution to say that that this price is fair, board resolution saying that they want to raise funds, the draft prospectus. All of these will go to the stock exchange, right? Stock exchange as well as SEC as well, another different set of documents, right? So once this gets approved only, you will be able to then come to the market and offer it to the public. So the investment bank will get involved in that process. And especially when you do a prospectus, last time I mentioned this, prospectus is technically the legal document that describes the details of the IPO. Prospectus is technically a binding document, right? So there shouldn't be claims that is being made that is false. You're trying to promote the company because the prospectus is where all that information will go. It will have all the information about the IPO, the details about, how to apply, where to apply, how to get the application forms, how to fill the application forms, where to hand it over, what price, and all those will be there. In addition, there will be details about the company to entice people to apply. And those information should not be false because technically, the prospectus is that legal document that will tell you all the information for investors to take a decision on the IPO. Okay? And therefore, the prospectus also has a section that covers all the risks that an investor can take to make sure that the investor understands that the risks that they are taking when they are investing in this IPO. So, for example, right, Uber, when they did the IPO in 2019, and this is not a unusual statement, but this is a statement that we don't usually see in our prospectus. But Uber came out with a prospectus when they did the IPO. Uber unveils IPO with the warning that it might never make profit because at the time of the IPO, Uber was not making profits. Yeah. Uber was not a profitable company. It was not breaking even. And when it came up with the IPO, one of the risks that it highlighted in the prospectus was the fact that we are still not breaking even. There is a risk that we might never break even. I mean, that's not the objective, obviously, but there is a risk that this company might never break even. Okay. So Uber Technologies with 91 million users said that it's growing, but the growth is slowing and that it might never make a profit. And in the US, you will see that you have two types of prospectus. We have now something a little similar, not the same, more so than we had those days, right? So not Uber, in the US, you have what we call a red herring prospectus. Red herring is actually this, it's a type of fish, right? So we have what we call the red herring prospectus, mainly called the red herring prospectus because of these big, bold, red letters at the top of the prospectus that essentially says, this is a draft. You should only rely on this information. It doesn't carry any price information. And people should make their own decisions, right? The information in the prospectus, it's not complete, can be changed, right? So because of that, they should be careful when reading this prospectus because when the final prospectus comes out, some information might be different from what is there in the red herring prospectus, right? So in this red herring prospectus, you can see here, like I showed you last time, it doesn't detail the number of shares, it doesn't detail the share price. But as you go inside this prospectus, it will tell you details about the company. So the red herring prospectus is good for investors to have a read about the company, understand its mechanics, understand its financials, and figure out what is the price I should pay to buy this company. Okay. So for the investors to do their own due diligence and own research, the red herring prospectus helps. Once the SEC approvals and the CSE approvals fall into place, the final prospectus gets issued. The final prospectus will have all the share details, the number of shares to be issued, whether it's an offer for sales, offer for subscription, how much, what is the price per share. All of that will be there in the final prospectus after the book building process has been completed. So once the prospectus is out there in the market, for a minimum of 7 days before the IPO, the prospectus should be available. The investment bank will now, the next step is to market this company. So they will go to their high net worth investors, they will go to their institutional investors like their fund management companies, insurance companies, pension fund companies, right? And they will talk to the fund managers there and they will try to convince them to come and invest in this IPO. They will try to convince them the merits of the company and why this is a good company and why they should invest. Right? So they will do all these sales presentations. They might sometimes take the company with them, sometimes they will not. And then you have these road shows, what we call road shows, where for big IPOs, you might go from place to place showcasing the company, right? In Sri Lanka, we say road shows with a slightly different meaning. But in the US, why they call it a road show is because now, US is a huge country, right? So you would go from, for example, from New York to the other side of the US, right, to California. You would use the highway and you would stop at different places and make investor presentations. And that's why originally that terminology, road shows, came into place, where you would do different investment banks would make different presentations at different counties, at different regions before between, say, I can't remember the exact, I think it's New York and California, right? So this is the highway connecting the two. And that's how that terminology came into place, road shows. So in Sri Lanka also, for very large IPOs, you will have road shows where you will go do regional presentations. You will go abroad and do presentations to investors abroad, right? To entice them to come and invest in certain IPOs. For small IPOs, our investors itself can take on most of the fundraising requirement necessary, and then the rest can be offered to retail investors. But when you want to make sure that a lot more investors are participating, and you want broad-based IPO, as well as when the IPO is very big and you need a lot more participation by a bigger number of investors, you will carry out more road shows for those IPOs. And ideally, in an IPO, you would want a mix of institutional and retail investors. You don't only want institutional investors, you don't only want retail investors. Because institutional investors, a lot of the time, these are not buy and hold, right? A lot of institutional investors are not traders. They are buy and hold investors, pension fund managers, mutual fund managers, insurance fund managers. They're buy and hold investors, right? So you don't want that IPO to come to the market and then be a flop. Then other investors don't make a gain out of it, although you're offering it at a discount. If nobody's buying or nobody's selling, you're not seeing in trading activity, then the share price is going to be mispriced, right? So that discount is never going to correct. So you want that balance. With retail investors, if you sell your entire IPO to only retail investors, then what happens is the other end of the spectrum, where you might see a lot of trading happening. Everybody wanting to sell, and the IPO price will crash, not go up. Okay. So you want a good balance of institutional and retail investors. That's one thing that you want to do. And also you want to build momentum and create that perception. Okay, this is a very interesting IPO. This is something that even if you can't get the number of shares that you want to in the IPO, you should still be going to the market and collecting more shares from the market, because this company is a very good company and will do well in the future, right? That's how you close that price gap. Just because you offer a share that is undervalued doesn't mean that it will reach its correct valuation. So the investment bank's job is also to create that market, create that interest in the market so that proper trading happens. So at the time of listing, once you do the IPO, your share can be undersubscribed, oversubscribed, or fully subscribed, right? There might be more than expected demand for the share, more demand, right? Equal demand or less than expected demand for the share. So if the IPO is undersubscribed, the company won't raise the money that it wants to raise unless otherwise it is guaranteed by a firm commitment. If it is oversubscribed, company will raise all the money it wants to raise, right? So if the company wants to do a 5 billion IPO and it gets 10 billion rupees of applications, doesn't mean that it gets to keep this 10 billion. It wanted to do a 5 billion application, it can only do a 5 billion IPO. It will have to refund the remainder of the applications. It is oversubscribed. But they raise all the money that they need to. Same way as a fully subscribed, you do 5 billion IPO, you get applications worth 5 billion, you are fully subscribed. Okay. But even after the IPO, even after selling the shares, investment bankers' work is technically not over. Because investment banker will then technically liaise with the registrars. Because afterwards it's the work of the registrars, right? They will have to now in Sri Lanka, they'll have to take those checks that have been sent, bank the checks, look at, if anything needs to be refunded, look at whether all the applications are, names, details are correct, reject applications, accept applications, upload those applications to the CDS, right? So all of these will be done by the registrar. An investment bank on behalf of the company will liaise with the registrars to facilitate that process. And then investment bank can advise the company on the basis of allotment, right? Can advise. They will not take the final decision, but they can advise the company on how to allot these shares. So this basis of allotment becomes a problem when you are oversubscribed. So in my example, if we had 5 billion IPO and you got 10 billion worth of shares subscribed, right? People applied. That means your IPO is oversubscribed 2 times more than what you need. That means everybody will not get everything because you want to raise 5 billion, you have applications for 10 billion. How do you allot? How do you say, no, your application is rejected, but your application is accepted? No, you have to be fair by everybody, right? So because of this, you have to decide, how do I allot these shares? How do I allot these shares, right? Usually now in IPOs, you will see you have different categories of investors. You have retail investor category, you have institutional investor category, you have mutual fund investor category, right? And there are different allocations that are given to each of these categories. So within the categories, you can be oversubscribed as well, for example, right? So within each category, if you have institutional investors, and of this 10 billion, 7 billion came from institutional investors, and only 30% of 5 billion, that is 1.5 billion, has been allocated to institutional investors. The institutional investor category is oversubscribed by a lot, and they will get very low number of shares than what they asked for. How do you divide this number of shares? How do you proportion this number of shares? All of these decisions will have to be taken, and the investment bank will give their 2 cents to the company, or can give their 2 cents to the company, provide advice to the company in terms of how best to do this allocation in a way that, investors are satisfied. Ultimately, the company will make the decision, right? But investment banks will have the know-how in terms of what type of investors they would want coming back, what type of investors the company might want to have in the company as investors, and to have that balance in the market of institutional and retail investors, right? So all of this type of advice investment bank can give the company. Aftermarket support. Aftermarket support means once the IPO gets listed on the market on the first day of activity, ideally, you would want to see your share price move up on the first day, right? That's that first day returns that we saw, right? First day gains on an IPO. Ideally, it's a sign. If your IPO is giving a good first day gain, it's a sign that this is a really good IPO, right? Investors get excited. It's good for the investment banks as well, because then the investment banks are able to do another issue. Like for institute, what that means is, if you see good price gains, then investors get interested to go for the next IPO, right? So they are, when you see good gains coming from IPOs, then you get interested to do the next IPO and the next IPO and the next IPO. They are interested to invest more and more and more money, right? And therefore, you don't want to see IPOs which are on the first day of trading coming down below the price that was offered. It kind of gives the investors, okay, I overpaid for this IPO. I could have got it in the market at lower prices. Then that makes it harder for the investment bank to do the next IPO, right? So because of this, investment banks would ideally, the company would like it. That's a prestige purpose, but investment banks would ideally love it also to see your price gain on the first day, because that makes it easier for them to do the next IPO and the next IPO and the next IPO and keep on that investor interest, so that they have enough investors to come and invest and help companies raise funds, and investment banks get fees out of that. So in that sense, they might do follow-up roadshows. They might have investor conferences, provide research, and do active market making, where they call up investors and say, in your IPO, because you were so many times oversubscribed, you only got 10% of what you wanted. In the market, you can try to buy a little bit more. This is why you should do it. This is the type of value the company has, and you can remind the investors why they came and applied for the IPO, and do that market making. That's the way you help the market, help investors have that good first day returns, right? So in Sri Lanka, for example, you had this, we have seen these cycles a lot, right? For example, just after the war in 2008-9 period, you saw a lot of IPOs that came to the market, right? So 2009, just after the war, the market was really doing well. If you remember, 2009, the market went up like 98% or 110%, and then 2010 also it went up another same amount, right? 98 or 110%. And 2011 only it started to really, fall. And some of the things that you see in markets that go up like this rapidly is the fact that investor interest increases. And when investor interest increases, that's when market manipulation starts to happen the most, right? So in 2009, you see around 2 IPOs were there in the market. By 2010, we had 8 IPOs that had come to the market. Why? When market is going up, when is a good time, that window of opportunity that we were talking about, are good times to come and sell new companies. These investors are looking for good investments to make, right? Or further investments to make. So it's the time to sell new companies to investors. So IPOs are frequent when markets are going up. So you can see here 2011, 13 IPOs that came into the market. But what started to happen, the first few IPOs in 2010 or so when they came, the first few IPOs gave investors good one-day returns, right? So they made really good one-day returns. And then as it went on, it's a story of time, investors became more and more greedy. So what happens when investors now they're looking to invest in the next IPO. So therefore, a lot of the time, what would investment banks and companies together do? They would not offer the same type of discount because they know there is enough demand for the IPO. So as you go along that cycle, you will see the more and more the IPOs that come to the market, don't have the same type of discount being offered. Some companies are actually overvalued. They're worth five rupees, but they are being offered to investors at 8 rupees because there's so much demand. High demand means that you can be taken advantage of, right? And this is what started to happen. And this is when, right, you started to really bad companies started to come with no motivation. They just want to raise funds to do their own activities, just want to raise money without a proper business plan in place. And investors got duped. Some IPOs failed. Some IPOs didn't give the type of returns, right? And investors burned their hands. And what happened when that type of manipulation happens? Then it becomes more difficult to do the next one and the next one and the next one. And what did you see happen to our IPO market? For the longest time, we barely had any further IPOs, right? After that 2009 post-war run, we barely had any IPOs that came to the market because investors were not interested in investing because they burned their hands. They've invested in IPOs where the share price fell after the IPO, and they were just not interested. Same way in the market also, the market had been manipulated so much, they were not interested in coming to the market, even forget about investing in a brand new company that they knew nothing about. Okay. So what does that create? That creates a place where companies don't have alternative avenues to raise funds. It increases the cost to companies. That type of market manipulation and that type of sentiment, ultimately, what does it do? It stops efficient transfer of funds. So if you do the IPO correctly, then investors keep on investing and companies are able to find ways to raise money. So companies can go to banks, or they can do debentures, or they can do IPOs, right? And they have different ways of raising money, which brings down their cost of funds. But when you don't have a method, when your alternatives dry up, then you have to rely on one party, and those types of monopolistic environments mean that your cost of funds increase, right? So market manipulation, that's the bigger problem of market manipulation to begin with. So 2021, post-COVID run, when the market went up by 80%, you didn't have to wait long before people were trying to do the same thing. Here, what happened over 3-4 years' time happened over 1 year's time, where the first few IPOs again gave really good returns. And then the last few IPOs didn't, right? Not every single IPO, but a lot of the last few IPOs didn't. And again, you saw the number of IPOs decreased. Okay. So in terms of debenture IPOs, it's a different story in Sri Lanka. Debenture IPOs, 2013, there were tax incentives that were given, which is where you saw this big spike in debenture IPOs with the 2013 budget. There were tax incentives that were given where they said debentures, no taxes. So there's this huge uprise in debentures. And 2015, I think they removed that. From the 2016 but onwards, 2015 budget, I believe they removed it to be effective 2016 onwards. You saw a dip, but it picked up again because of Basel III requirements and so on. Banks needed to raise debentures, right? And debentures anyway come with usually the price of a debenture IPO is 100. You can't manipulate the price. It's a fixed income instrument. So it doesn't go through the same type of volatility that you will see or the hype or excitement that you will see in an equity IPO. So because of that, you don't see that huge volatility with debenture IPOs as much as you see in the equity IPOs. And you can see in terms of the money raised also, the debenture IPOs have raised much more money in Sri Lanka than equity IPOs. when we were doing well post-war, and then we had the manipulation round, and after that, we barely raised any money through equity IPOs in Sri Lanka, other than again, post-COVID round. Any questions? So private placements are again another way. It's not an IPO, but it's again selling securities, but now through a private offering. Okay. So private placements are where you're selling securities of the company. So you might think it's an IPO, right? Because you're selling shares of the company. But here, you're selling shares not through a public offering, you're selling shares through a private offering. So you might, okay, there was a time, so during this manipulation period, in 2011, you saw a lot of private placements that happened in Sri Lanka as well. Right? A lot of the time, there was a whole period where companies were coming up with private offerings, promising an IPO at the end of the tunnel. Okay. So they were telling investors, get in now, buy now, and we will do an IPO within the next 6 months to 1 year to 1.5 years. We will do an IPO. And then you can make bigger returns on your investments. Because today, because you're coming in as a private investor, you will be able to come in at a lower price, and we will do the IPO at a higher price. And you will be able to make a bigger return from your investment, right? Which again worked for a select few investors. It's because the first few can work like that. Then what do you see? Then you see the worst issuers coming into the market, investors getting greedy, not looking at the prices, not looking at the valuations, and buying companies, whether the issue is good or not, by overpaying for companies sometimes, right? And you will see that there was then a lot of laws that got implemented in terms of private placements in Sri Lanka as well. So private placement again is where you sell securities to investors who are not the public, right? You can sell it. It can be retail investors, but it is not a public offering, meaning the number of shareholders or the number of investors in that company will still be less than 50. It's an alternative to IPO because it's lower cost. So if you don't think of the way of being manipulated or why you're doing this, it's a way of raising funds at a lower cost. Okay. So that's the reason why private placements are there, and investment banks can help facilitate that private placement process because you still might need a prospectus. You will need to find investors. It's just that the scope and the regulation that governs the private placements are lower than what it would if it was a public offering. Loan syndications and project financing we spoke about. And last, just to mention M&A advisory. Yeah. So M&A advisory means mergers and acquisition advisory, where you have companies taking over each other or merging together, right? Where you have two companies, A and B, merging together. You can either be merging, or it could be a takeover where A acquires B, right? A acquires acquirer and acquiree, right? So you can have a takeover or a merger. Now, how do investment banks come into these takeovers or mergers between two companies? They can come in at the stage of, they can be the people who convince, right, A to acquire B or B to acquire A. Or so investment banks, for example, in the US, when you start off in investment banking, sometimes you are given targets in terms of trying to figure out companies to go and find companies that are good acquisitions or good takeover targets, so that you can go and pitch to another company to go and acquire that company because you're trying to generate business, right? Investment banking is much more cutthroat and much more competitive than it is in Sri Lanka, right? In US, because you have a bit larger number of workforce, larger number of larger investment banks, and the fees are higher, right? So with this, the industry is much more competitive than what you would see in Sri Lanka. You would have a competitive landscape, but much more competitive landscape if you would think of countries like the US. So it could be the deal initiation itself is done by the investment bank. But if not, when the company A decides that they want to go through a merger or they want to acquire, they identify a target, they will engage the investment bank to do that negotiations and to do that valuation on their behalf. So will be. You should, if as a responsible company, responsible for your shareholders' interest, you should engage a third party to do that negotiations on your behalf, right? Because the company might not have the ability to do that. So you will hire an investment bank and we will hire an investment bank. And these two investment banks will be two different investment banks. You should never hire the same investment bank. Okay. Now, if you hire the same investment bank, imagine A is trying to acquire B. Okay. A will want to acquire B at the lowest price possible. B will want to sell at the highest price possible. How does that happen? How does the investment bank work on behalf of both companies? You can't. You shouldn't, right? Because you are not, you will always work on behalf of the person who's paying you probably the higher fees, right? So ideally, you would want to have two investment banks engaging with each other, right? A will have one investment bank, B will have another investment bank, and they will be engaging with each other, trying to figure out the best terms and conditions. So the investment bank will do the valuation for the company. A will do its own valuation. The investment bank will do the valuation for A and for B and for the merged entity or the taken over entity. And same for investment bank too. They will see what is the value from this takeover. Is it worthwhile doing or not? Right? So each investment bank will do their own valuation pre and post takeover for each of the companies to see how much are these companies worth? How much should they be paying? Should each of these clients be paying for the company? So they will do that and then they will negotiate with each other on behalf of A and B. They will negotiate the terms and conditions of that transaction. Okay. So kind of like, for example, you know that in Sri Lanka with the debt negotiations that are going on for the ISB, you know, we have engaged two parties, right? So there, the part in terms of the debt restructuring negotiations, you have one party working for the government, you have another party working for the creditors. Okay. Same thing, when you're looking at a merger and acquisition, you have one investment bank that will work on behalf of the acquirer and one for the acquiree, or in terms of the merger. Okay. So the investment bank, if they do their own analysis, they will figure out, okay, what are companies that should be looking out to acquire, right? They'll look at the acquisition criteria, they'll search for the target. Or A can approach the investment bank and say, I'm looking to expand my company. I'm looking at these features. Can you find me a company to acquire? Then the investment bank will look at the different criteria and look and search for a target, right? And then after doing that planning and evaluating and valuation, one of the most important things, the valuation of the acquirer, and the merged entity, that negotiation part will happen, due diligence part will happen, sales and purchase contracts, and then you will help the acquirer find financing, right? I mean, you need money, and you will, if they don't have, the investment bank will help find that financing, and in that whole overall implementation process, all of these at each stage, investment bank will help facilitate the process, right? So working with the lawyers, working with the auditors, doing the due diligence. They won't do the due diligence, but they'll work with the auditors to do the due diligence on behalf of the companies, right? To do the negotiations. All of this, the investment banks will work together. So for example, again, When you remember some years back, there was a request that came from the central bank that required banks to merge with each other, right? There was a point where there was it in the budget? No, I can't remember, but there was something that came that said NDB and DFCC must merge together to create a bigger development bank, right? And that merger negotiations for each bank, they had an investment bank that was hired. So both entities had investment banks working for them, where the negotiations were being made with the investment bank, so that the two entities, the management would talk with the investment banks, and the investment banks would negotiate on behalf of the management, work with the legal teams, right? Work with the auditors in terms of trying to do that negotiation. So ultimately, it didn't happen, but that's an example. Okay, so that finishes the investment banking part. Any questions? Go ahead. They're separate legal entities. Well, that's what I was showing. Investment banks do not operate as commercial banks, right? If you have a full service investment bank, you can have commercial banking services. That's not in Sri Lanka. Right. So this is where I was showing in terms of some investment banks in Sri Lanka. On this side of the table, you saw Bank of Ceylon's investment banking division. So that's a division. That is within Bank of Ceylon, a division, commercial banks investment banking division, right? People's Banks investment banking division. So that's inside. It's not a separate legal entity. Versus if you take NDB investment bank, that's a separate legal entity. It's a subsidiary of NDB Bank. Or Equity Partners is a separate legal entity, which is a subsidiary or a joint venture with DFCC and HNB. Okay. So then you can have non-bank investment banks, like you have CDCLSA or Capital Alliance or Asia Capital or Asia Securities, right? Sorry, am I saying the name right? So
yeah,
okay. Sorry. So these are different investment banks that you will have, and you can see here it doesn't necessarily need to be a separate legal entity. It can. Does that answer your question? Not necessarily. Yeah. They can have separate division, yeah. And they can have a license, yeah. And you can see MBSL is one of the ones that have got that license, corporate financial advisor license, because these are the ones that I have put a cross on, are the ones that have currently got the license. Others are in the process of getting the license, because right now it's still being implemented. It is not mandatory unless you want to do like a public offering, then it becomes, then you would have to start to get that license, right? Okay. So brokers and dealers are not going to concentrate on too much, because we've spoken about these separately, and you know a lot about brokers and dealers and how they work. But here we're going to concentrate on more on the margin trading and the short selling section. But in terms of brokers, a few things to keep in mind. Brokers again are types of arrangers to transactions, right? They are arrangers to transactions. They help different parties meet. So they are the ones who will, for example, in your stock market, when you have stock brokers, You will have, obviously, now we
Excuse me,
don't,
Vinda.
sorry.
The slide that we can see is the select investment bank.
Obviously, thank you. There are some questions that have come that I have missed. What is the investment? What is the benefit that investment banks get as a form of this advisory services, commission or any other charges? They charge fees. So investment banks will charge fees in terms of the advisory services that they provide. To do a valuation, it might be a fixed fee. To do an IPO, it might be a variable fee based on the size of the IPO, right? But they charge fees. Is ADB Wealth Management an investment bank? ADB Wealth Management is a fund management company. ADB Investment Bank is the investment bank. Right. So in terms of the brokerage services, what was I saying? Yeah. So brokerages are essentially, they are also arrangers to transactions. They help people meet, right? They are arrangers. So in that sense, although we might not feel it, because when we do a transaction, um, we just type it, online, we will type it and we will put it on the online platform, and then somebody else will put a bid. So we don't see this, right? That they are arrangers of transactions. But this is more apparent when you do large transactions. When you do a big deal, you will generally not want to put, okay, I want to sell 1 million shares. You don't put that 1 million shares generally on the board, right? You don't just put it on the board. You will try to find another buyer for that. And you will call up a broker and say, I have 1 million shares to sell or 5 million shares to sell. And you say, okay, find me somebody who wants to buy this. This is the price I'm willing to sell it at. And the broker will then find another buyer that might want to buy that share, and there will be a negotiation of prices between the two parties, and once you come to an agreement, then that will go through the exchange, right? So essentially, what is the function of a broker? They help arrange transactions, and there will be a commission that is charged for that. So the commission in Sri Lanka for brokerage services is 0.65%. You have an overall charge when you trade in the stock market for all trades. For all trades, there is a 1.12% charge. Of that 1.12%, 0.65% is brokerage charges, right? So when you're trading in the market, you have what we call market orders, limit orders, short sales, margin trading, right? So short sales and margin trading, we're going to talk about today. And then market orders and limit orders will come to in the equity section. So I'll just jump that. Now in Sri Lanka, we don't have this in this terminology. You have who we call full service brokers and discount brokers, right? Here in Sri Lanka, all brokers charge 0.65% for transactions. But you can actually differentiate the services you provide, and you can charge higher or lower depending on the services that you provide, not in Sri Lanka, right? So full service brokers are brokers who provide not just online platform services or brokerage services, they also provide research. Versus discount brokers might simply provide you a facility for trading. Like, for example, they'll give you an online platform and you can do trading on that online platform. They'll charge a lower fee. They won't give you any advice. They won't give you any research, right? But they will charge a lower fee by simply providing that service, right? Full service brokers, on the other hand, essentially will provide investment advice. They will provide research, right? They will have their so with that, they might be charging higher commissions on the trade. So we don't have this distinction here. We have full service brokers and discount brokers to the extent that, some brokers will provide more research facilities than others, but there is no distinction between the fees that are charged between the brokers.